When most people picture owning a senior living facility, they imagine an idyllic, recession-resistant real estate investment, complete with a long wait list of wealthy clients happily paying rent. The day-to-day reality is a highly regulated hotel layered directly on top of a 24-hour medical clinic. Look at this chart mapping the typical revenue flow. We start with a massive gross rent number at the top, but after the specialized operating expenses are systematically whittled away, owners are left holding a terrifyingly thin net profit margin, usually sitting somewhere between 1 and 3%. So if the underlying math is identical, why is operating a senior care facility vastly more dangerous and volatile than running a grocery store? It starts with the price of admission. Before a single resident moves in, you take on a massive fixed debt load to build out specialized commercial infrastructure, requiring commercial kitchens, accessibility modifications, and emergency call systems wired into the walls. That heavy debt load and mandatory physical footprint puts immediate pressure on that tiny 2% margin from day one. Once doors open, a relentless pressure emerges from the facility's total reliance on its frontline caregivers. This comparison data shows the problem. The grocery industry battles a 40% staff turnover rate. Senior care facilities deal with that exact same 40 to 56% turnover. When employees leave, you're stuck in an endless loop of recruiting and retraining. That cycle constantly eats away at the bottom line. In a supermarket, a newly hired teenager can be trained on a cash register or stock boxes in a few hours. Elderly care requires specialized, heavily trained workers who cannot be easily replaced with general labor. Because the business cannot rely on cheap, interchangeable labor, every single staffing change becomes a direct, expensive threat to that fragile profit baseline. Operating costs take on a different dimension when we shift from the supermarket model to a retail pharmacy model. A pharmacy is required by state and federal law to have an expensive, licensed pharmacist physically on site every single minute the doors are open. A senior living facility faces very similar legal mandates. Depending on the exact level of care, you must have licensed nurses and certified medical staff available 24 hours a day, 365 days a year. If a nurse quits without notice, or a severe flu outbreak forces you to run short-staffed, you cannot legally operate. You have to instantly hire expensive, heavily marked-up temporary agency staff just to remain compliant. This line graph maps exactly how that operational shock plays out. Your revenue line, the fixed monthly rent, stays completely flat. But the moment you bring in emergency medical staff, your variable costs sharply spike, driving that tiny profit margin directly below zero. Because your fixed costs don't pause, and strict liability laws enforce mandatory medical coverage, a single afternoon of mandatory emergency staffing can instantly turn a profitable month into a catastrophic financial loss. If the baseline rent is essentially a loss leader, and the operational margins are this fragile, where does the real wealth in this industry actually come from? Survival depends on ancillary service fees, requiring the monetization of every extra touchpoint. The real profit is generated through high-margin add-ons. You charge extra for specialized medication management, premium meal delivery directly to their room, and escalating tiers of daily personal care. Even the most basic domestic routines, like washing and folding a resident's laundry, are transformed into escalating daily service fees. Owning a senior living facility is an investment in a highly leveraged, operationally intense hospitality and medical hybrid. Owners fight a daily war against volatility, managing a massive fixed cost structure while remaining entirely dependent on service fees to survive the relentless weight of mandatory medical staffing.